So the question is to see how the introductions of a public administration modifies our computable general equilibrium model. So this introduction may have several implications. First, public administration collects revenue, taxes, so it's a revenue for public administration. And so taxes may have an impact on the economy, of course. Second, the public administration makes some expenses, some outlays, and so it means that these outlays may also have some implication on the economy. And third, public administrations may have an imbalance between revenues and outlays, for example, a deficit, and it may also affect the economy because somebody else has to finance this deficit. And of course, it may also have an impact on interest rates. We will not consider this last case in this lesson, and so we will suppose that there is a budget balance. We will see the impact of disequilibrium between public administration's revenues and outlays in another lesson. So let us look at taxation. There is a traditional distinction made about taxation between direct taxes and indirect taxes. So direct taxes are taxes that are directly paid to the government by the taxpayer. So it's, for example, an income taxation, and it is on households, or a corporate tax on firms. And so it means that the agent that gives the money of the taxation to the public administration is the agent which is taxed. Okay? And it's not obvious because, in fact, it is not the case when we consider indirect tax. So, direct tax, the person who gives the money to the public administration is the agent who is taxed. Indirect taxes are applied on the sales of goods and services or the manufacture of goods and services. And they are initially paid to the government by an intermediary. Very often it is a firm. And the firm then adds the amount of the tax paid to the value of the goods or the services and passes the total amount to the end users. So, for example, the household. So it means that firms collect indirect taxes and give the amount of these taxes to the public administration. So this is why we call it an indirect tax. So what we will do in this computable general equilibrium model is that we will suppose one type of direct taxation, an income tax on household, and one type of indirect taxation, which is a tax on consumption of goods and services. Let us consider now public administration's outlays. So it may be demands of goods and services in order to fulfill public missions like police, like army, like justice, and so on. Subsidies to producers, to farmers, or transfers to households. What we are going to do here is that we will only consider one type of outlay, public administration outlays, so it's demand of goods and services. So let's start with the descriptions of the public administration's revenues, and in particular the revenues drawn from direct taxation. What we consider here is a unique direct taxation on households. And this tax is defined by an income tax rate, which is called ITR. So ITR is defined in percentage, and it is levied on household income. So it means that ITR will be in at least two equations, because in fact it generates a revenue, and it also means that disposable income is less than income for households. So let's start with these latter aspects. So in fact, the household has an income coming from the ownership of productive factors. So this income was called INC. And so it means that with this income tax rate, right now, the household cannot allocate the total income to its consumption. It can only allocate a part of this income. And the part of this income is 1 minus ITR times INC. And so this is why we define a disposable income, a new variable, which is called DISP underscore INC, and this variable must be equal to 1 minus ITR times INC, INC being the household's income coming from the ownerships of primary factors. The second equations in which income is introduced, ITR is introduced, is the revenue for the public administration, because of course this direct taxation generates a revenue which is ITR times INC. Let us now introduce indirect taxation, that is to say a tax on consumption, which is in fact paid on the sale of goods and services. And so, in fact, firms collect this tax when they sell goods and services. It means that they add the taxation and it increases the price paid by consumers. And once the firm has collected this taxation, it gives these taxations to the public administration. So the rate of indirect taxations is called indirect underscore tax in sector I, and the implications of these indirect taxations is that there is a difference between the price received by producers, PY in sector I, and the price paid by consumers, P in sector I. And so the equation, by definitions, is PY in sector I times 1 plus indirect underscore tax in sector I must be equal to P in sector I. So let's now see how the outlay of public administrations is modeled. I remind you that we suppose the unique outlay by public administrations its demand for goods and services. Of course, in the reality, we have other types of public administrations outlay, like subsidies to corporates or transfers to households. But we do not consider here this type of outlays. We only consider demand for goods and services. So the first implication is that it will modify the equilibrium of the good markets, since there is a new source of demand. And so you have to think about how this public demand for goods and services will modify the market equilibrium of goods and services. So we have also to define the level of public demand for good I. This is something that I call CGI. So in fact, there is a total public budget, which is called budg, B-U-D-G underscore EXP. So this is something that is defined by another equation, which is the budget constraint of the public administration. So in fact, the public demand for good I is defined by the equation P in sector I times CG in sector I must be equal to a constant defined on I times budg underscore X, which is the total public budget. And so this is as if the public administration had a Cobb-Douglas utility function, and the result is that the distributions of public demand by sector is constant and is a constant share of total public budget. So we already mentioned the sources of revenues for the government. It is a direct taxation and an indirect taxation. We've already defined the public expense by sector. It is a demand of goods and services. and it is in value a constant share of total public expense. So it remains that we have still to determine the level of total public expense. So it is not determined until now. And we also have to understand how the government's budget affects the financial equilibrium in the economy. So it's a key issue that we do not have looked at until now. If we think about it, this is a general equilibrium model, so we must have the supply of funding which is equal to the demand for funding at the global level, that is to say at the level of the entire economy. So what happens in the rest of the economy? So consider households and firms. There is no saving, neither from households nor from firms. There is no investment, which is a demand for funding from firms in particular. And there is no financial relations with the rest of the world because, of course, this economy can finance the rest of the world or be financed by the rest of the world. This is not the case because there is no relation with the rest of the world. So it implies that in the model that we have designed, we have a government's budget which is balanced, because if we consider all other agents, there is neither demand for funds nor a supply of funds. So at the government's level, the budget is balanced, and we have revenue must be equal to total public expense, which is called BUDG underscore EXP. So this is the variable that we have called previously in the equations determining the level of demand, public demand in each sector. And so the revenues on the left side of this equation, it's direct taxations plus indirect taxations, which is determined elsewhere. So it means that these new equations must determine the total public expense. So here is the social accounting matrix that will give you all the data for the design of the computable general equilibrium model that you will have to do. So let me present it following the usual way, and making notice of what is new in this social accounting matrix. I start with the production in each sector. So it is 5,000 in the agricultural sector, 11,000 in the industrial sector, and 9,500 in the services sector. But here there is a slight difference because we also have indirect taxes collected on the sales of these goods and services. So 100 in the agricultural sector, 220 in the industrial sector, and 180 in the services sector. So these taxes are collected by firms and given to public administration. These productions of goods and services requires some intermediate consumption. Here is the matrix of intermediate consumption of the good in row by the sector in column. And then we have remunerations of productive factor. So here is the matrix. We have remunerations of labor and capital. So with this remuneration of productive factors, we have the formation of income for households. So in fact, the remunerations of labor allows the formations of income of household by 7,200. And the revenues from capital are given to enterprises, and in fact enterprises decide to distribute total profits to households for 2,800. And so with this income, households can finance in fact two things. First, final consumption of 1,700 in the agricultural sector, 1,200 in the industrial sector, and 3,400 in the services sector. But there is a second thing that households finance. It's the payment of the income tax given to public administrations for 3,700. And so we see that we have revenues for the public administration, so revenues from income taxation and also indirect taxation. So it means that with these revenues, public administration can in fact operate some expenses with demands for goods and services, 400 in the agricultural sector, 1,500 in the industrial sector, and 2,300 in the services sector. So here we have introduced public administrations in this social accounting matrix. We could be interested in the balance between the total of a row and the total of a column. So for example, we've got at the level of households a balance between total revenues, which is 10,000, coming from remunerations of labor and profits distributed by firms, and the payment of income taxation, and the final consumption in each sector for also 10,000, the total being 10,000. We also have another balance at the level of public administration, because in fact public administrations collect revenues either from income taxation or indirect taxations, the total being 4,200. And with these revenues, the public administrations can spend some money under the form of demands for goods and services for a total of 4,200. And let me also talk about the balance between supply of goods and demand for goods. So for example, in the industrial sector, we've got a total supply of goods which is 11,220. So it comes from the production in volume, but also it is with consumption tax included, and so we include the payment of 220 of indirect taxations on the sales of these goods. And so the total production value of the productions of industrial good is 11,220, so with the inclusions of indirect taxation, and it corresponds to the total demands for goods and services in the industrial sector, coming from first household for 1,200, second public administration 1,500, and intermediate consumption by each sector 2,010 from the agricultural sector, 3,510 from the industrial sector, and 3,000 from the services sector. So right now you have everything to design a computable general equilibrium model with the public administration. So this is something that you can do, but of course you have to calibrate this model with the previous social accounting matrix. So there is one thing that which is a little bit subtle, and I would like to talk with you about the thing. So it is in fact one problem. You do not have the rate of taxation, for example concerning indirect taxation. You only have the amount of taxations which is collected. So you have to be very careful, and you have to calibrate the rate of taxation from the information that you know. So what you can do is to start with normalizations of the final consumption price, the consumption price, P0 in sector I equal to 1. So you give the value of 1 to P0 in sector I in each sector. So it means that you make a normalization. So this is something that you write within the program. Then the next equation, you do not write this equation within the program, but you can in fact think about it, and you can use, for example, a sheet of paper, and this is in order to understand the calibration of this rate of taxation. So what you've got is that you've got P0 in sector I, which is equal to Py0 in sector I times 1 plus the rate of taxations in sector I. So you can multiply both sides by Y0 in sector I, and you've got this equation, P0 in sector I times Y0 in sector I. So you've got this, which is equal to Py0 in sector I times 1 plus the rate of taxation in sector I times Y0 in sector I. And this is equal to Py0 in sector I times Y0 in sector I plus Py0 in sector I times Y0 in sector I times the rate of taxation, indirect taxation in sector I. And so this last item, this is something that you know because it is in fact the amount of indirect taxations collected in sector I, which is something that you can call, for example, INDTAX in sector I. So this is something that you know from the social accounting matrix. So you can write that it is the last right side of this equation is equal to Py0 in sector I times Y0 in sector I plus INDTAX in sector I. And so from this equation you can write that Py0 in sector I times Y0 in sector I times the rate of taxation, indirect taxation in sector I is equal to INDTAX in sector I. And so you can in fact derive from this the calibrations of the rate of taxation in sector I, indirect taxation. So indirect underscore TAX in sector I is equal to the amount of taxation collected in sector I, INDTAX in sector I, over Py0 in sector I times Y0 in sector I. So the problems with that is that you do not know Py0, you only know P0. So what you can do is that you can write that the last item is equal to INDTAX in sector I over P0 in sector I times Y0 in sector I minus INDTAX in sector I. And here you've got something that you can use for calibration, because in fact you know INDTAX in sector I, you know P0 in sector I because you normalize it to 1, and you know Y0 in sector I because it comes from the social accounting matrix. So you know all these elements, and so you can calibrate the rate of taxations in sector I, indirect taxation. Okay, so what I would like you to do is to study a reform, which is a decrease by 5 percentage points of the income tax rate. You have to implement it, and you have to look at the effects of these reforms on all variables of the economy.